So depreciation, Brian, what is it?
So depreciation is a term used to describe your ability to write off on your taxes or to have an expense against your rental income for the investment that you've made in your property. The investment typically consists of two major categories, one being land, and the other one would be the building. The land itself is not depreciable, and typically the land, if it was not broken out in your purchase of the asset or the investment property that you have, the land can range typically between 10 and 20% of the value of what you're purchasing. It would be a good idea to try and get the value and separate it out, but as a rule of thumb, between 10 and 20% is land. So what that means is the remaining 80 to 90% can be depreciated. Now the challenge there is with depreciation, it typically is straight line depreciation. And what that means is you take a value, and we can use $1 million as a good example, and we'll just say that's the value of the building. You would take that $1 million and you would, when it comes to residential, which would be a rental property that you rent out to individuals, families. It can be short-term rentals, which we can talk about in a second. But anyways, residential is depreciated over 27.5 years. Mm-hmm. So basically you would take the $1 million and divide it by 27.5 years. And each year that you own that property and are renting it out, you would take 1/27.5 of that value and depreciate it over time. When it comes to commercial real estate, and primarily for small business owners who are either buying their office or thinking about buying their office, or even if you get into the situation where you want to buy a commercial property and lease it out to others, the length of that time is 39 years. And again, it's straight line over those 39 years. There are some advantages to doing what's called a cost segregation study.
Right.
This is something that's I think it's been around for a while, but it's something that recently my clients have been taking advantage of, and there are several companies that do cost segregation studies. But basically, the cost segregation study allows you to take that building and split it between building and equipment. And you're saying, well, why would you do that? Well, 27.5 years or even 39 years is a long time to take advantage of your investment. So when it comes to a cost segregation study, it allows you to take out certain items within the building itself that are considered equipment from a depreciation standpoint. And so you say, well, why is that important? Well, depreciation can be taken over a much shorter period of time on equipment versus a building. So equipment actually, when it comes to depreciation, can be accelerated. It can be either 15 years, it can be 7 years, it can be as low as 5 years. And there are some additional, what are called Section 179 cases, where you can actually take most of that equipment depreciation in the first year that you purchase the building. Mm-hmm. So without getting into too much details, that's kind of the long and short of depreciation. Now, the other thing is, let's say you buy a rental house that you're going to be furnishing for, let's say, a beach rental. The furnishings that you put into that building, again, have to be depreciated. But those are strictly considered equipment and can be accelerated. So that's kind of nice. If you plan on doing any leasehold improvements, in other words, you buy the building and then you're going to then take that building and renovate it. Well, in the year that you renovate it and it becomes rentable again, you can accelerate that depreciation related to the renovations. So there are some limitations when it comes to depreciation. In any type of rental activity is mostly considered passive income. And so when it comes to your adjusted gross income, if your adjusted gross income is over a certain dollar amount, which currently is $150,000, then you are not able to take full losses against rental properties. That's not only depreciation, but it's other things too, but that is something to consider. One thing you also have to consider when it comes to rental properties is what's called depreciation recapture. This occurs when you go to sell the property that you've depreciated. The recapture is that the IRS basically is saying, and I'm obviously very paraphrasing this, but the IRS is saying, hey, look, we gave you the advantage of that depreciation at the time you took it. When you go to sell the property, if you sell it for the same value you purchased it for or more, there's a good potential that you're going to have to recapture that depreciation. It's probably easier to do that on a pen and pencil example for you. But the reality is, let's say the $1 million piece of property, we decide to sell it several years down the road, we've depreciated it for $150,000. The IRS says, okay, you're going to have to recapture that depreciation and pay taxes on it. Right. And unfortunately, most of the time you have to recapture it at ordinary income rates versus capital gains rates, even though you've owned the property for several years. So there is a challenge associated with that. And again, your best bet is to get with your CPA, and they can walk you through several different scenarios when it comes to this. The final point, I think, other than, David and John asking me some additional questions, the other point is there is the ability, if you are doing short-term rentals, which short-term rentals are, and this is primarily on the residential side, you don't typically see it on the commercial side, but on the residential side, if you do a short-term rental and you are actively managing that property, there is the ability to count it as ordinary loss versus passive loss. And so you're able to take advantage of losses even if your income is above the 150 adjusted gross income level. And then finally, one other point, if you are a real estate professional and you're managing the property, the 150,000 does not apply. You're able to take up to $25,000 in losses each year that you own the property. So that was a long-winded answer, David, to your question, but if you got any other questions.
That's great. So in fairness and just a summary per se, the reason why people get excited about depreciation is because it helps them, especially from an investment, holding real estate from an investment perspective. It helps to shelter legally some of the income that's coming in over the course of that, and the IRS gives you the benefit of that. But when that recapture comes in and you have to pay the piper, you always have to pay the piper right at the end of the deal. You're saying that there's the depreciation comes back in the recapture. Sometimes you have to make an adjustment based on the ordinary income of the IRS applicant or taxpayer at that point in time. And that you break that out over all the different depreciation schedules, whether it was considered an improvement, whether it was considered like a fence, different types of things like that. And that will give the owner of the property the total tax consequence. Is that also a fair way to summarize it?
Yeah, I think that's a good way to describe it. There is, and obviously with the IRS code, we know how thick it is and how complicated it is. There is one thing that you can do when you get ready to sell your property, is if you decide you want to reinvest that money into another investment property, you can do what's called a 1031 exchange. And when you 1031 exchange, like kind exchange is another term that's used. When you do that, you just roll that depreciation as well as any capital gains into the next property. And so you're able to defer the taxes on that down the road.
Yeah. So for your advice for just small business owners, we work with a lot of people on the residential side, but we also work commercially with small business owners, and they've spent all these years being tenants, and they're so focused on running their business that sometimes they haven't taken the time to see what the net effect would be of actually buying a piece of commercial real estate for themselves. And one of our favorite things that we like to do is when we're helping them buy real estate, to buy a little excess real estate, or create a little excess space for them to then create a tenant space for them to then be a landlord or a landlady. What would you say to somebody that wanted to explore that? What would be the benefits of them exploring that, aside from what people know off the top of their head, building equity for themselves instead of paying a landlord rent?
Yeah, I think it's part of the maturation process for small business owners. You start your business, usually you're working out of your house. You then get yourself an office building that you're renting from somebody. And then eventually, several years down the road, it could be 2, 3, maybe 5. In my case, it was 8 years down the road. You look to buy an actual piece of real estate that you can take advantage of the appreciation of that building, as well as you can rent it out to other people. So in my case, I'm able to rent out part of my office building to other tenants. And, fortunately, most of them are clients of mine. So I'm able to rent that out. So I not only have the advantage of the appreciation, but the rental income that I receive covers a lot of my costs associated with owning the building. So I strongly encourage small business owners, if you're to that point in your life cycle as a business, to try and take advantage of buying some real estate. You'll find that the banks are very, very favorable towards small business owners owning their own building, especially if you occupy 50% or more of that building. Banks really enjoy those kind of loans. They see that you've got a buy-in into the building yourself, as well as that you've got some residual income coming in from your tenants.
Yeah, absolutely. John?
Yes, I do. Brian, just to rehash on the recapture portion, you had mentioned that real estate professionals get kind of a special treatment in the tax code. Is that a $25,000 cap on the recapture, or how does that work?
Yeah, so it's actually you basically create a profit and loss statement for that rental property, and it not only includes the depreciation expense, but all of your other expenses of operating the building. And if the loss is $25,000 or more each year, you're able to take advantage of that part of the IRS code that says if you're actively managing it and you're a real estate professional, you can take up to $25,000 a year in losses. Now, the other thing I didn't really stress was if you do go over that 150 or 150,000 AGI, and you're not a real estate professional, or even real estate professionals that lose more than 25,000 on the property, those losses don't go away. They get suspended, and you keep track of them year over year. And so you're able to accumulate those losses. So if you do end up selling it, you can take those losses against the gain that you may have on the sale of the investment property.
Yeah.
Got it. Okay, great.
Now, if there's someone that, let's say that someone carries on that they want to be they're a real estate professional and they want to do that, or it really, I guess for anybody, we always hear attorneys are telling us put this property in its own LLC, right? For a lot of different legal reasons, it makes a lot of sense. You run a profit and loss on the LLC, you manage it, you maintain it, makes it clean accounting. Say someone started to accumulate multiple properties. Okay, let's just say that small business owner is an insurance agent and they want to be in various parts of town. So as they expand their brand, they start opening multiple locations that they purchase the real estate every time they open an office. Is there a benefit, a tax benefit, or would you organize that person where they would bring all those properties in one real estate holding company for tax purposes, or does it not matter that way? What would be your recommendation?
I think there's a limit to the number of LLCs that you want to own. I'm not a lawyer, but from a legal standpoint, having them in separate LLCs makes a lot of sense. But sometimes the legal side of things can get, overwhelming with multiple LLCs. I have no problem with seeing multiple buildings within one LLC, as long as you understand that there is a risk if something happens at one of the buildings, it could impact the other buildings. And the main reason, and I guess this wasn't your question, David, but I think it's something that people need to be aware of, is a lot of my clients are S corporations. And with S corporations, you really don't want to put any real estate in your S corporation, because you lose the ability to step up the basis at the time of you passing the property on to your heirs. Whereas if you put it in a single member LLC, or even a multi-member LLC that's not an S corporation, then upon the passing of the owners of that LLC, the basis gets stepped up. And so, and that's an accounting term that you would want to talk to your CPA about. But basically, it eliminates the majority of the capital gains and other items when it comes to actually selling the real estate.
Yeah, I've so many questions that come up, and I guess the global perspective of everybody's personal. When I say global, I mean people have a lot of things going on, especially if they're small business owners, they're entrepreneurs, they're pursuing a lot of things. Can you look at people's world globally for them? Like sit down with someone and help them see all the different buckets that they're working on and help them come up with a strategy that, how does this entity need to be filed, and how does this tax bill need to be structured against all this stuff? Is that a realistic expectation today, where it seems like people have so many things going on, to look at the whole world of an individual or a family, a household, and to give them the interconnectivity about how all those entities work together, Brian?
Yeah, I call it a holistic approach to tax planning, where you really sit down and you just basically, we conduct some sort of interview to kind of get a sense of your assets, your income streams, your upcoming events, major events that could be occurring, whether it's kids going to college, or quitting a job and starting your own business, or other life-changing events, having children. We take a look at all of that, and then we take a look at the options of, what are the pros and cons of of being an S corporation, let's say, for your business, and or if you're looking at buying a piece of property, let's talk about the advantages, disadvantages of doing so. Because buying a piece of property is not for everybody. The environment that we're in could impact that. The interest rates obviously have something to do with that type of an investment. But yeah, we take a look at all of that. Typically it's an hour to maybe an hour and a half long meeting where we're able to get a pretty good sense of you know, what makes the most sense for you, for your particular situation. So we'll give you advice. Obviously, you take that advice for whatever it's worth to you, but it tends to work out pretty well with most of our clients.
Yeah, well, that's great. And Brian, if people want to get in touch with you, is we've got your number up here. Are you at the place where you could take on some new customers and potentially do that planning with them now?
Yeah, the summer is the best time. Usually between the months of May and mid-August are the best times to sit down with me. The rest of the times, unfortunately, seem to be taken up with tax deadlines. Not only the April 18th deadline that we're all familiar with, but with the extensions and all, we tend to get tied up from the middle of August through the end of or mid-October with the rest of that stuff. So,
well, we appreciate it. This has been great. If you guys want to reach out to Brian and ask him any questions or schedule a time to see him, you can reach him at 843-971-5866. That's 843-971-5866. Brian, John, and I can't thank you enough for your time. We appreciate your time today.
you're welcome. Thank you guys. Enjoyed it.
Bye-bye.